Hi everyone, George here, and I'm going to provide you with another video with respect to some tax knowledge. So before I begin, the common disclaimer, these views may or may not represent the views of my employer. They're completely my own. I am not a CPA or chartered accountant, and it's the knowledge presented here is not meant to be tax advice. It is purely for instructional purposes. Please do your own research and go into more depth after viewing this video. With that being said, I'd like to talk about two things with respect to rental income. The first one is just briefly do a quick overview of what is CCA, capital cost allowance. And the second one is to go over a special rule in tax with respect to CCA and rental losses. And I'm going to post two valuable links that you can do further research, one being an income tax folio with respect to capital cost allowance, and the other one being the rental guide, which I like to tout a lot because out of the plethora of documents that the CRA has published, I find it packed with valuable information. Right, so first point, what is capital cost allowance and what is UCC? So CCA is capital cost allowance and UCC is the undepreciated capital cost. And the common word that describes CCA in ordinary language is depreciation. Now, there is a difference between how accountants depreciate assets and how we are supposed to depreciate assets as per the Income Tax Act of Canada. So as a matter of fact, what the CRA specifies in this case is that each asset has a particular class. Each class has a rate of depreciation and a method. You can either use declining balance, and the majority of the assets are declining balance method, and there's a few straight line methods that I've come across. So all that information can be found pursuant to paragraph 1100 sub 1 sub A of the regulations. So if you have the Income Tax Act book in front of you, it's all the way in the back. Right. Now, undepreciated capital cost is actually the remainder of the value of the asset being to be depreciated after depreciation was taken in prior years. So I got two values here, and these are completely arbitrary amounts. Now, when the actual owner took possession of the rental property, what he would have to do to establish the undepreciated capital cost, or the cost of the addition, would be to take the total cost that he incurred to buy the asset, factor out the land, okay, get the value of the building, because you cannot depreciate land, get the value of the building, add to it whatever costs he incurred to get it ready for it to be a rental property, an income property, and subtract any government subsidies he may have received. Generally, that's how it works, okay? Now, what we have here is this particular owner has two rental properties, one in Westminster Road, and the other one on Barclay Avenue. As you can see, they have a quite handsome income from, actually she does. I have a fictitious taxpayer called Marguerite, and she owns these buildings. So her gross rental income is $43,200. From that, she can deduct advertising. Total cost for both buildings is $1,325, $7,700, and mortgage interest, not including capital, $17,000. So I guess maybe her broker did not do a good job. Easy guys, I'm not trying to trash mortgage brokers. Okay. property tax, complete total is $13,000. Water tax, $1,350. School tax, $1,510. Insurance, $4,100. Snow removal, yep, we do live in Canada, $2,300. Total expenses are greater than gross rental income. What does that mean? We have a loss, a rental loss. What is a rental loss? A rental loss is a non-capital loss, which means we can deduct it against ordinary income. However, the special rule that I want to bring to your attention is you cannot use depreciation to increase a loss. You can only use depreciation to the extent of bringing your rental income to zero, right? So in this case, ideally, if I am using a good software, it would recognize this rule and would not take any depreciation on my assets and instead claim the $5,085 rental loss against my income. Now the moment of truth has arisen. We're going to take a look at our taxpayer, okay, Madame Marguerite Cormier, and I've already inputted these amounts into UFile, and we'll see what UFile does, okay? So let's take a look at that. Here's the 2020 return for Marguerite, and let's take a quick look at the interview, okay? The interview being here. So she's a nurse, okay? She earns quite a handsome sum of money, okay? Notice that in Quebec, the income is slightly higher than in the federal because in Quebec, the Quebec tax is all private in health insurance plans, right there, okay? And she has a registered pension plan, some union dues. What I did not show in this example is that for the professional due, you can claim the GST, HST rebate. I didn't want to go there at this point. And she also played her cards right and contributed to her RSP, right? So the deduction limit, bang, and the first 60 days contributed an additional $10,500. And I inputted her two rental properties here, Westminster Road, CCA. Again, how did I establish this? I looked at the guide and I said, okay, this building fits in class 1, just for the purposes of this example. But you should certainly take a look at in the guide all the other, or in the income tax folio, all the other classes, and you can fit the assets that you have for that rental building. For example, if you provide laundry services, you can certainly depreciate the dryer and the washer, right? That would probably be class 8. All right, and I also have the triplex. Okay, great. Here's the income, gross income, and expenses. Okay, I tallied up all the 3 different taxes and put them into one category. Snow removal. Okay. I did not complete labor costs. This is a form specific to Quebec where you have to identify the people that did, the contractors that did work on your building. Okay, and here's my rental property. Okay, the adjusted cost base, an arbitrary amount that I hypothetically filled out, but here's my opening balance, right? Apply this fully to the rental income, and these are properties solely for rental income. No portion of them is her personal residence, okay? I did not dispose of the asset. The half-year rule does not apply. It would apply in the year of acquisition, and I'm not asking in any manner to limit the CCA of this class. this entry cell exists there if at any point in time you want to claim less CCA than the maximum that you'd like to do so. And basically I did the same thing for Barclay, right? Okay, so let's take a look at the tax return. I've already reviewed my work. I made sure that my numbers jive, my taxes deducted at source appear at the right line. The income that I reported amounts to the same thing on my T4 and appears on line 101. These are basic checks that everybody should do, regardless of how you're doing your tax return. Okay, now, tax return. Let's see what happens. Okay, this is actually, if you're mailing the form, and I highly recommend that you do not mail it, net file it, okay? And this is the basic printout that you get from a paper copy that is more readable. This is made more for machine learning. So when you actually send this document to the CRA, they scan it and read it. Again, net file. Don't even look at this. If you want to consult, though, the actual tax return for human perception, this makes more sense. Okay, let's just take it from the top. Okay, we got Miss Marguerite Cormier. She's single. She was born in 1980. English, resident of Quebec. And she said yes to the Elections Canada questions. No foreign property. Not exempt under the Indian Income Tax Act. That's her income. And guess what UFile does? It takes the non-capital loss against her income. So she has income of 87,000 minus 5,085. That is equal to 81,915. From that, she deducts the additional $5,000 of registered pension plan, $10,000, $10,500 from RSP, $600 of union and professional dues. So as you can see, this is the CPP/QPP enhanced contributions as of maybe last year or this year. And after all is said and done, her net income is lowered to $65,692.53. So overall, we've done a good job, right? And after all is said and done, her tax payable, right? So let's go to page 4. Actually, her tax payable, okay, the refund is not so important. What is important is line 435, less any Quebec abatement or any other refundable credits. So, and why do I say that? That's important for figuring out your marginal tax rate. So if you take 81,049.75 minus 1344.71 minus 2260, $6,782 federally only, which is a good tax payable. We should also have her marginal tax rate. Here it is, 18% federally and 20% for Quebec, for a total of 38%, which is great for someone that started with $80,000/$90,000 worth of income, right? And she came close to equilibrium. You know, you have a great sum here for the federal, a modest return for Quebec. Unfortunately, that's how it works. So for Quebec as well, Quebec has harmonization agreements with the federal government on many fronts. So here we go. There's the non-capital loss. So everything is gravy here. So the basic takeaways from this video is that it's not always advantageous for a person to take depreciation on rental income. If there is a non-capital loss, use it. And it looks like UFile 2020 automatically determines that for you, right? And just to prove it once again, if we take a look at a rental statement, the ones being sent to the government, as you can see, we are, let's see if we can zoom in on that. There you go. Well, it still might not be clear, but that's the best I can do. We started with undepreciated capital cost of $325,800. We took 0 CCA, and we are carrying forward the full amount for next year. And in next year, if your expenses are less than your income, UFile will take the amount of depreciation needed to bring your rental income to 0. And just to double check on Barclay does the same thing, right? So I hope you enjoyed this video, and if you like it, go ahead and click on the like button and subscribe. Certainly tell your friends about it. I greatly appreciate you watching this video and telling your friends about it. Take care.